Hi, good evening and good day to everyone. Thank you all for logging in. My name is Harsh Gupta. I head the cross-border payments business at Cashfree. Cashfree, as a lot of you might be familiar with, is one of the leading payment aggregators and fintechs in India. They occupy a large share of wallet in India's e-commerce and domestic payment ecosystem. Cashfree recently has, in fact, for the last 2 to 3 years, have ventured in streamlining the complex ecosystem of cross-border payments as well. And they have been the first to be granted the coveted payment aggregator license for cross-border payments by RBI, India's central bank. I'm joined today for this discussion with two very, very esteemed panelists from Trilegal. Thank you so much for joining in. Uh, just uh, so first and foremost, I'd like to introduce Mr. Nagapan, Mr. Meyapan Nagapan, who's a partner at Trilegal. Mr. Meyapan brings a deep expertise in international tax, GST, litigation strategy, and has advised some of the leading global technology and e-commerce companies in navigating a very complex landscape of taxation in India. He has provided expert opinions before several foreign courts on digital taxation issues and published multiple academic articles and chapters on taxation and on the overall digital economy. Thank you so much, Mr. Nagapan, for joining in. Um, we also have Mr. Jaydeep Reddy, who's a partner in TMT practice at Trilegal. He focuses a lot more on disruptive and emerging technologies, primarily focusing on fintech, digital assets, data protection, and AI, which is the buzzword these days. Jaideep has advised leading global platforms on high stakes regulatory issues and represented them before the Supreme Court and major high courts in India. He has written and been quoted extensively on the emerging technology issues and regularly takes up teaching assignments on leading law schools in India. He is both qualified to practice in both India and California. Thank you both for your presence today. I'll also give a very brief introduction of myself. As I mentioned, I head the cross-border business at Cashfree. I've been a banker predominantly for most of my professional career. I have around 10 plus years experience at Citibank, where I was managing the new age economy vertical for global markets. So predominantly, I was looking at corporate sales and structuring vertical within Citibank. I've also been associated with various cross-border fintechs in the Indian ecosystem, advising them with respect to infrastructure setup and GTM strategies as well. So before we and the broad agenda for this discussion today is if you are an international company looking to scale into and diversify your risk into emerging markets, why we think India is the place to be, why we think India it is the right time to enter India, and we wanted to share some insights with the panel here with respect to navigating some of the complexities involved with respect to legal, regulatory, compliance, taxation, and cross-border payments. So we wanted to provide a very comprehensive understanding of if you are an international company looking to scale in India, what are the major pitfalls that you need to navigate through. Before we go into the complexities involved from a regulation, taxation, and payment standpoint, I would first like to share my opinion on why I think it is right time to enter India. And one thing I can say that I've been a fintech or a financial markets proponent for around 15 odd years, and I think this is the most exciting time to be part of the financial ecosystem in India. We've seen a lot of disruption happening through digital payments already via mechanism of UPI. Uh, and we have seen similar evolution happening in the last 4 to 5 years in the cross-border domain as well. So going a little more further into why I think India is the place to be for any global franchise. As per a recent IMF study, 75% of the GDP growth in the next few years, in the next 5 years, is going to be fueled by the emerging economies. When I say emerging economies, I'm primarily focusing on India, South Africa, Brazil, Indonesia. These are the primary economies. Uh, this is primarily fueled by faster consumer spending versus the developed economies, which are showing much more stable and tepid growth numbers. Within these emerging economies, India stands out as one of a very, very unique player just because of the sheer size of the consumer base in India. India is one of the largest growth markets that has been seen. And in general, the openness towards international trade that has been observed and prioritized by the Indian government in the last 5 to 6 years. India is significantly outpacing other leading emerging markets, such as Indonesia, South Africa. If I deep dive a little bit more into why I think and what is the factors which is driving this growth, the first and foremost is India's large tech savvy population. So India has a huge population which is English speaking in general, very tech savvy, very open towards a preference for international brands. And in the recent last couple of decades, they have seen increasingly high disposable income. So in terms of some of the industries which have seen phenomenal growth is in terms of luxury goods, e-commerce, beauty, electronics, and e-commerce segment in general have seen a large growth because of this particular factor. Uh, the second and probably a very significant factor is the digital revolution that has transformed India in the last couple of decades. uh, India internet users has almost doubled in the last decade. So we had around 500 odd million internet users in 2018, and currently there are 900 million users. I just want to take a pause to fathom the sheer size of this. 900 million internet users in India constitutes more than 10% of the entire world population. So obviously the base here is extremely high. This also couples with a very widespread and explosive growth in digital payments. So I'm sure a lot of you are familiar with the success story of UPI, India's domestic payment mechanism, which has seen explosive growth in the last decade or so. Uh, UPI has made in digital payment in India absolutely seamless, transparent, and easy. We have seen the government of India and the regulatory authority, NPCI, focusing on making UPI international in the last couple of years, and I think that's one of the most significant priorities of NPCI in the next 5 to 6 years. If I throw just some little numbers, uh, a recent survey sort of indicates 75% of Indian consumer base selects UPI as the preferred method for any payment. 8 billion UPI transactions were processed in 2023. These are obviously fairly staggering numbers. I just take a pause here because I've been speaking in a monologue for quite some time. Would like to invite Mr. Jaydeep and Nagapin if they can share some insights with respect to the conversations that they are observing, the trends that they are observing in the industry, particularly with respect to international companies looking to enter India.
Sure. Thank you, Harsh. Hi, everyone. Nice to speak to you, and thank you for listening. Uh, as Harsh indicated, India is a market which is seeing great interest by merchants around the world. The reason is the total addressable market. You heard the types of numbers that Harsh has put out. There's a high digital penetration among Indian consumers and also an increasing disposable income among consumers. So, most international merchants, global businesses with aspirations, or businesses with aspirations of going global, see India as one of the key markets to expand into. And we as a law firm often get queries from global internet businesses, particularly on what are the legal and tax do's and don'ts to be kept in mind as they look to address this opportunity in India. When doing that, generally the key aspect is how do they build up the payment rails to accept payments from India and make payouts to Indian users. These could be merchants or they could be end users. And that's where we've actually seen some opportunities where we collaborate with payment providers like Cashfree to provide a solution to international merchants who need both legal and regulatory advice as well as a payment solution which is compliant. So broadly speaking, there are there are two modes by which an international business can enter India. Either the business stays offshore and collects payments from India, or the business comes onshore onto India and sets up an entity in India. Obviously, setting up an Indian entity is a lot more involved process, needs a lot more resources to be dedicated in terms of deploying personnel on the ground, having an entity on the ground, investing time in day to day compliance, but also potentially in the long term can have an exponential reward. That said, it's also possible to address a good portion of the Indian market by staying abroad and integrating with a payment solution that allows the merchant to accept payments through its foreign entity. The Indian regulators have made a big push towards digital payments and have introduced solutions to enable the collection of payments from Indian users through digital payment modes. For instance, the recent, and we'll be speaking about that in more detail. Harsh mentioned about how Cashfree has obtained the PACB authorization. The PACB framework, that's the Payment Aggregator Cross Border Framework, was really a step forward to improve the clarity in cross border payments, where a global merchant could address the Indian market by using a domestic payment mode. Earlier, a global merchant could still address the Indian market, but they would use a foreign payment service provider, and an Indian user would necessarily need to pay only through very limited modes, such as a credit card. Now, credit card penetration is very low in India compared to UPI penetration. India has about, I think, about 100 million credit cards, is the last report that I came across. On the other hand, there's 350 million active UPI users, and this is active users and not just total users. So the total addressable market is very high as compared to simply having an international payment gateway where you can only accept credit cards. If one has a payment aggregator who's able to enable all payment modes, including UPI, the transaction volume and therefore revenue increases. I'm happy to come later to some of the legal and regulatory considerations, but broadly, this is an overview of some of the big picture considerations from uh, uh, the perspective of a merchant considering India as a market.
No, thank you, Jagdeep. I think this was fascinating. Mr. Nagapan, I also wanted to, and this is something which at least I personally have always struggled with, is with respect to taxation. Would love to hear your insights because Jagdeep sort of mentioned that there are essentially two avenues where a foreign company can look to scale in India. One is they set up a legal entity, or versus them selling from an offshore standpoint. Taxation is usually one of the big considerations prevalent in this decision making. Would love to hear your thoughts with pertaining to this.
Sure, Harsh. Thanks for having me here. And yes, and in addition to what Jaydeep said, we always start with legal and regulatory, but ultimately, the decision for any foreign business in terms of what sort of operation, scale, size, presence they want to have is also driven by tax, and whether it is onshore or offshore, tax is an integral part of that decision making. Because I think there are trade-offs there on the tax side as well. There are three or four taxes that typically most of the players are impacted by. Of course, it's extremely product specific. It depends on whether it's B2C or B2B. And in the digital world, I think the products continue to innovate at a very rapid pace. So I think one of the challenges that sometimes companies face, and I'll quickly go through the different taxes and kind of what are the trade-offs that come up between being onshore or offshore. But I think one other problem that does come up is the government has a very sometimes a static view of business models in terms of, they think of e-commerce as a certain thing, they think of gaming as a certain product, right? They think of, but then you have companies coming up with products like metaverse, which then, it is both e-commerce and gaming and social media, and there could be a digital asset involved, and you have these separate provisions under the law which says, notwithstanding anything else contained under the law, you will be covered under one regime. And in reality, that really doesn't happen. So, with the rapid pace of innovation, I think one key thing which everybody sort of does as part of this is that, whether you're offshore or onshore, the one aspect that remains the same is determining what is the classification of your product, be it for income tax or for GST. Is it a trade of a good? Is it a digital good? Is it a service? It is something else, So the models vary a lot, and the implications, there is a whole range. It could go from 0% tax to like 18% on GST. It could be like 0% on income tax to like, 25 or 35% if you have a permanent establishment. So I think there is a lot of variation in it and the scope for structuring, and it also depends on the your terms and conditions, your UX. You could have something that looks on the front ending similar, but at the back end, your terms and conditions and how you structure the product could be very different as well. So some of the key considerations from a tax perspective are, of course, income tax, GST. You used to have equalization levy earlier, that was also a relevant consideration, and you have withholding taxes, which is the other one. So, as a foreign company, if you are trying to render uh, services from offshore, um, you have something called a significant economic presence, which is if you have more than a certain threshold number of users in India, or transaction value, if you cover that, then you kind of trigger a taxable presence, and then you can look at, depending on whether the entity is coming from a treaty jurisdiction or not, you may be able to claim treaty benefits and say it's not taxable in India without a physical presence. But in the digital world, there are many companies, because of regulatory reasons, that are based in non-treaty jurisdictions. There are many people who are based in Jersey, or other countries which have better regulations for the specific product they offer. So then that sort of creates a lot of issues when it comes to India, even from a cross-border perspective. Some of these provisions are less tested, and even for entities which do come from a treaty jurisdiction, then it's a little better. But when it's B2B, then from a withholding tax perspective, we've seen issues come up because domestic entities then say, show me, proof of tax residency, show me, and this is an annual sort of a thing. The person who's claiming treaty relief has to produce documents, and there are challenges and costs, and, otherwise withholding tax has to be done at the India level. Whereas if you're onshore, right, I think, yes, you don't have to deal with all of this, but there is a potentially, higher rate of tax. There is lesser scope to say you're not taxable at all, compared to when you're offshore. The second thing is, most companies end up setting up their own subsidiary to undertake India operations. So the manner in which you then do it, how the product is licensed, what sort of model do you follow? Most platforms are global platforms. So all of that becomes a structuring exercise. And fundamentally, the key takeaway is that because of transfer pricing, requirements, there is a margin that has to be maintained at the India entity level, no matter what activity is taking place. And therefore, usually having an on-ground presence is more compliance, more sort of tax cost on average compared to being offshore. Being onshore also increases the risk of tax audits because you're more accessible to the authorities on ground here. It's much easier to serve notices on you, much easier to kind of attach assets, which authorities do struggle when it comes to offshore businesses. Something as simple as, issuing a summons is quite challenging going through the current process. So you for similar business models, it's usually the domestic companies that usually get rounded up first, and then the focus shifts. Wherever there is money, then the tax department follows. It's only a matter of time. So I think that way it does make a difference in terms of you get to see what's going on ground, and you can have more time to strategize your own response in those situations. With respect to GST, when you're an offshore service provider, like I said, the product categorization makes a big difference. It could be OIDAR, it could be a digital good, it could be you could be treated as an intermediary service. Sometimes you could be a deemed service provider. So if somebody else is providing services to your platform and you are enabling it, you could be a deemed service provider under that construct. So the tax base also varies, right? Is it on the commission? Is it on the total amount of money going through that particular gaming platform or social media platform? All of these are kind of contested also. There are tax notices that do go out when companies are operating this business models, and the GST department is quite active on these. When it comes to India, yes, there is lesser scope. Again, more or less everything is subject to GST, but you do get a credit of it. And But the ability to structure and be more tax efficient is on average better if you're placed offshore. So that's kind of the overarching sort of takeaway. Being offshore has certain benefits, more complex, has more potential to take a more tax advantageous position and mitigate yourself on the risk and audit side. But being domestic, I think, is not a decision people take necessarily for tax reasons, but it is for business reasons, and it is because of better compliance, and you kind of scale and grow the business. So that's how I would see the trade-off there.
Sure. Thank you so much. I think this is very illuminating. As an ex-banker, I necessarily have to give one caveat here. The intent of this entire conversation is to give a broad overview. None of this should be construed as an advice to any foreign company. Obviously, it is very nuanced, and they should consult their auditors in for a specific in terms of what is the most optimal and compliant manner to enter it. But within this, Mr. Lingam, I had a couple of follow-up questions, terminologies which are very, very frequently asked by some of the merchants that are cash-free we engage with, international merchants looking for payment solutions. One is a very commonly used term called ORDR. If you can throw some light on that piece. The other I'll also just ask is, I think goods is easier to understand. In terms of services, I think it's very difficult in the new digital era to define where the service is actually being consumed. Does that impact the taxation piece?
Sure, sure. I think those are two key points. I think so. OIDAR, and I would disagree that goods are easier to understand as a
Okay.
different space. Also, I think it's a lot more challenging once you get into the products. And I'll give you a couple of examples on the goods side as well. To start off with OIDAR, OIDAR is information database access and retrieval services. It's a mouthful, but what it actually refers to is pretty much online automated services which are rendered by an offshore digital service provider, which is consumed by a person in India. Now, the thing is, of course, earlier there used to be things about human intervention and whatnot, and all that's been deleted. So you can think of it as basically a digital service, which is pretty much has, it is automated and it is rendered over the internet. It is accessed over the internet predominantly, and that's what the intention is to cover. Um, that has a specific regime under GST where a offshore service provider has to directly register with the GST authority in India, and they have to directly discharge the GST. Now, most of the time, the GST, the way it is structured is that any business in India who's importing a service, the importer has to discharge GST on a reverse charge basis, because the tax policy angle is that to enforce provisions against a non-resident is difficult. So you kind of catch the person who's in India and say, hey, you collect it and you pay it on their behalf. Now, businesses are generally registered for GST, so it's easy. B2C and unregistered businesses who fall below the threshold, it's difficult to track it. You can't get an individual. It's too cumbersome from an administrative standpoint to enforce as well. So they have put the obligation on the foreign entities to do it, and most of them do it. The larger ones for reputational reasons. The smaller ones may or may not do it because it's difficult to get caught. But the GST department has been active to send out information flyers to people that come across in their domain. And we have seen clients who are simply not aware. For them, it comes as a surprise that say, but I'm outside of India. Why should, I mean, how is a tax applicable to me? Right. So I think that way, but once they're informed by the GST department, that, hey, listen, this applies to you potentially, why don't you assess? And once we say, yes, it is applicable based on the product analysis, clients have become compliant thereafter. Right. So that is something that does come up. And the Second question was around,
Where the services are being consumed, essentially.
yeah, location of services and where they are consumed. So normally the deeming fiction under GST is that the location of the recipient is where the service is deemed to be consumed. That's a general rule. Of course, there are lots of exceptions, and to generalize, typically the exceptions say if it's a concert, if it's an event related sort of service, then it is where the event is. Or if you're an intermediary service provider, then it's where the intermediary service provider is located, right? Now, in digital services, sometimes this also comes up. So for example, let's say I am providing a intermediary service, so let's say a content creator can kind of offshore content creator is enabled through my offshore platform, is consumed by a person in India, right? So I could take the position that that the platform provider is only a intermediary, in which case it is located outside India, it is consumed also outside India, it is deemed to be serviced outside of India. But tax department will come and say, no, this is OIDAR, the user is in India, so it should be deemed to be consumed in India. So there is always a contest around it. It is a contested point, but in my view, the law is fairly clear in terms of it is the rule of thumb is wherever the service recipient is located, that's what matters. And it's not, and of course you have to be careful about the exceptions. But in OIDAR, what happens is there is seven criteria, out of which two non-conflicting criteria you have to satisfy. So typically it's like, where is your IP address? Is your payment rails from India? Is your bank account in India? So registered address in India. And the reason they have said two out of seven, shouldn't be non-conflicting, is because somebody in US is traveling to India and accessing, let's say, Spotify or Netflix, right? Suddenly it shouldn't be that, so their permanent address, their banking details will still be outside of India, while IP may be in India. So that conflict. So that is why they're trying to track through these seven criteria who's located in India and how do you prove a service is consumed in India, because that's what gives you the jurisdiction to tax it, because GST is a consumption tax. So that's the two things that come up. And just very quickly on the goods part, goods is very complicated simply because, and I'm telling you, when and the front ending, if you see a lot of the UX of products, right, there'll be coins, they will say tokens, this terminology is very commonly used. And tax department picks up on this and says, is this a VDA? Are you selling tokens or coins? It's a digital good. Many times it's only like your 1 rupee will be sitting as a coin or something for you to use as a in-game currency or against services, right? It's probably a voucher, it's probably so it's not always, it's not a digital good that you can take out in most situations and as a separate property exist outside the platform. But there is a lot of questions that come up around it. There are situations where sometimes it is actually digital goods, but then we have tax department saying, oh, this is OIDAR service, now you have to pay taxes in India. So I don't think it's so apparent, because the front end, I understand why they can get misled, because the front end looks the same, but it's the terms and conditions and it's sort of what rights you give the users really depend, matter towards the classification from a tax perspective.
Sure. Thank you. I think we could go hours and hours on this topic. But one observation, as somebody who is not a tax expert but who has been engaging a lot with international merchant, is I think the process is getting more streamlined. So as you rightly said, a lot of international participants are not aware of OIDR. But when we have made them aware and we have connected them with the right partners, the process for getting OIDR, in fact, even a GST for an international player is pretty streamlined. So that's something which has been an observation that Cashfree at least has seen in the last 2 to 3 months.
No, and to be fair, I think earlier the tax department used to be a lot more, if I can say, aggressive in terms of straight away issuing summons and kind of starting to threaten. I think the approach now is a lot more taxpayer friendly. I think there are 2 or 3 rounds of communication saying, you may not be aware of this. You may potentially be subject to this. So kindly check with your lawyers. And I think that puts us in a better way. I don't think even foreign entities cannot be aware of these provisions. Uh, Sometimes the reaction is, to a more defensive. It's more, we are not tax evaders. This is not intentional. Why are you imposing penalty on us? Straight away issuing show cause notice. So I think that way it has become much easier for them to do business and stay compliant.
I think I think in all the budget announcement as well, the honorable finance ministers make sure that I think it's going to be far more easier and there's going to be a lot more trust towards any tax-paying individual or company. That's at least the tonality that's coming in from the government, which is I think also reflected in the ease of doing business in India. I think that's something which is substantially doing progressively better in the last 5 years, and I think that's one of the reasons that the taxation is a little more streamlined. Jumping in, Jaydeep, thank you so much. You be patiently hearing. Would love to hear with you, especially pertaining to the transactions which leads to payouts. International company coming to India, selling to an Indian consumer, then they have to obviously take the money out. One is what are the regulatory nuances that they need to navigate through. Secondly, I think both of us are familiar with a lot of AML considerations that these companies need to be very careful on. If you can share some insights on that, that'll be very helpful.
Sure, sure, Harsh. So essentially, there are two broad laws that that impact this flow. India has a payment systems law and a foreign exchange control law. The foreign exchange control law, affectionately known as FEMA, it regulates the cross-border transactions. So it has various detailed granular guidelines on both inward and outward transactions, current account and capital account transactions. In our context, most transactions we would be referring to for purposes in this webinar would be current account transactions because they would be purchase of goods and services. So, generally speaking, for pay-ins, that is an Indian user paying to a foreign merchant, there is a per user limit of USD $250,000 a year across all outward spends of an individual user. This includes investments as well as current account transactions, which gets cumulatively counted into an annual limit. So these transactions can go through as I mentioned, can directly be processed by the card issuer through an international payment gateway or an Indian payment gateway through various payment modes, payment aggregator rather. And where it is done by an Indian payment aggregator with a cross-border license such as Cashfree, there are certain regulations on the limits for these transactions and the purposes of these transactions and how these aggregators need to keep the funds. They work with an authorized dealer bank to do that. Coming to the payouts, so for instance, if there are any, let's say, content creators receiving proceeds from their content from an international app, that would be an instance of a payout. So payout is considered basically an export of services because the content creator is generally providing their service in exchange for consideration being received from abroad. And therefore, there is no limit on how much money can be received through these channels. Again, the payment aggregator cross-border enables this receipt through an export collection account. These entities are mandated to carry out diligence of the customer from an EML perspective because they are RBI regulated entities. So they are bound by both the Prevention of Money Laundering Act as well as the RBI direction on KYC. And therefore, customer due diligence for any of these pay-ins and payouts is something that is mandated. So the merchant receiving the funds and onboarded onto the payment aggregator or the user in either case will need to be diligenced by the aggregator to satisfy itself of the AML considerations. So the AML aspect is not too different as far as the cross-border flow is concerned because even the domestic flows require AML considerations. But obviously, where there are cross-border payments, there are some heightened sensitivities, and transaction volumes and amounts can also be higher. Patterns can be different, jurisdictions can be different. So AML is definitely a key factor that any RBI regulated entity will need to keep in mind, and therefore a merchant would have to duly cooperate with the entity to provide the required documentation.
Thank you, Jaideep. I think this was very enlightening. I just wanted to add new color more from a payments backdrop rather than from a regulatory standpoint. So first, what Jaideep sort of elaborated was from an individual when he's making a payment outside India. That is typically, for example, if I'm booking a hotel in Europe or I'm making an investment and I want to invest in Apple using in Nasdaq, that for every Indian citizen, there's a limit per financial year of $250,000. That's roughly INR 2 CR. So that's something which is validated against any international transaction that you do, even if you're buying a small app on App Store as well. Even a 99 rupees App Store is tracked against that LRS limit. This is something from an individual standpoint. Now, from a business standpoint, there are numerous regulations which are required for a company to make a payout to outside India, which is making a money transfer outside India, whether they're purchasing goods or services. Typically, a lot of them pertain to what Nagavind was also mentioning with respect to taxation. Have you made the requisite tax confirmation on a tax on a per transaction basis? This is something which was required. And if I look at my 2014 to 18 era of Citibank, this was one of the key friction points which were observed by large behemoths like Netflix and Spotify coming to India. Essentially, they are essentially collecting 800 rupees from an Indian consumer. For them to comply at a transaction level with all these requirements was absolutely a nightmare. Which is why, as Jedi was mentioning at the start of this discussion, that the PSCB circular, which allows a fintech essentially to enter the fray and digitize the entire experience, was absolutely quintessential. Because without that, that business was not scalable at all. Now, for a company like Netflix, who's selling to individuals in a very small ticket granular flows, but doing millions of transactions on a monthly basis, a player such as Cashfree, who's licensed by RBI, can now enter, firstly, provide them with the entire domestic payment stack, which includes UPI. So previously, these companies could only offer cards as the major modes, which is, from a penetration standpoint, it is single digit. And if you go to a tier 2, tier 3, it will be very, very limited, the penetration in India markets. Versus a UPI, which I think has now closer to around 65-70% penetration in India. So that exponentially increases the market that they can participate in when they're selling to an Indian consumer. Secondly, every single transaction, the regulation involved, while still very stringently followed, is digitized entirely. So, for example, from a transaction which is 800 rupees being collected from the likes of Spotify or Netflix to making the payment, providing a valid underlying documentation, doing all the sanction and AML related checks on a transaction, everything is still being done, but it can completely be automated using technology providers which are prevalent now in the Indian financial ecosystem. So there are providers who can do sanction checks, KYC checks, AML checks in a real-time basis. And now, as a licensed entity, Cashfree can provide and enable this solution. So that's one of the landmark change. And Jaideep, I would love to hear from you as well. Is to my mind, I think PSCV was a landmark change in India's complex in the cross-border domain. But you obviously participate in other jurisdictions as well. Where do you think India stands with respect to payments in terms of especially international payments, and how is the journey looking like?
Sure. So, I mean, the key difference that India has with other jurisdictions like the US, Singapore, and Europe is this foreign exchange control zone. So those jurisdictions don't necessarily have these types of limits or other restrictions. Therefore, it is sort of left to the market, and there is a little more leeway. Having said that, within the constraint of FEMA, the RBI has been trying to facilitate transactions in a more seamless way, because prior to the PACB circular being issued, the limits were much lower for transactions. Now the limits have been increased. Also, there's a general push towards digital payments, even at a policy level from the finance ministry. So there is generally an interest to reduce the time and cost associated with cross-border transactions. There are new technologies like the Finternet being discussed at a global level, which actually aim to integrate payment systems of different countries and reduce friction. Today's cross-border payments rely on correspondent banking largely, which leads to a lead time of a few days and FX charges and um, uh, uh, time and cost, which is less than ideal as of today. Of course, the industry does its best even in those situations. But the idea that India is trying to move towards is to reduce the time and cost associated with cross-border payments. And that's actually an agenda of the G20 at a global level. So hopefully that, and India is moving in step with that. So hopefully that friction will reduce. And in the meantime, the PACB is a new regime. So one is sort of waiting and watching on how certain aspects under it pan out. But largely, it's a facilitative regime and is intended to be facilitate cross-border commerce.
Uh, thank you, Jaideep. One thing I would be fascinated to know, I think, so you are one of the leading authorities in terms of disruptive technologies. A lot of interest comes from international merchants who are not in traditional lines of businesses. For example, content providers. For example, even to a certain extent, you are players using blockchain technology or some form of coins, not necessarily crypto trading, but some form of coins as well. Now, I think obviously the regulations in India are evolving in this domain, but in general, would love to hear your thoughts in terms of, in the spirit of our current regulations, are these more favorably looked at? Is there something which is something you see a lot more freely happening in the next few years in India domain?
Sure, sure. So there are certain industries which, even at a global level, are seen as potentially high-risk industries. That includes gaming and crypto assets. Having said that, these are some of the largest tech businesses as well. So uh, there are various Indian unicorns which are in these two sectors, right? And are a big part of India's startup sector. Have received large amount of venture capital and are doing very well. Same thing at a global level. There are these are emerging industries, although considered high risk by the regulated sector. So um, i this is an area where different regulated entities may take different risk-based views on this. So obviously, the more non-traditional the sector is, the higher the due diligence is. For instance, for the crypto sector, the RBI issued a circular in 2021, which said that a bank or regulated entity, before facilitating any transactions on virtual currencies, is to do due diligence in terms of FEMA and the Prevention of Money Laundering Act. So earlier, of course, there was a prohibition that was set aside by the Supreme Court, and subsequently, this instruction was issued. So there is due diligence that is exercised. Of course, the level of due diligence varies based on the sector, but we are seeing payments being facilitated across sectors. And of course, the more progressive entities do onboard uh, across sectors, and really the law permits such onboarding. There's no prohibition on any particular sector, barring obviously illegal activities. So long as an activity is permitted by the law of the land, it's just a question of the diligence checks being passed.
Sure, sure. Thank you. I think one of the very common questions also that I end up getting from international merchants, would love to hear your thoughts, would that India's obviously seeing a lot of evolution with respect to data protection. I think we also had inputs requested for in terms of DPDP recently by the government for any individual to participate in. How does it impact foreign companies looking to operate, especially digital platforms in India?
Sure, sure. That's a great question, Harsh, because India has introduced a new data protection law, the Digital Personal Data Protection Act. It's been enacted by the Parliament and published, but has not yet become effective. That it's expected to become effective in the coming months. Importantly, this law applies to any entity carrying out business in India, even if not present in India. So it's what we call an extraterritorial provision. So similar to the GDPR, in fact, where even if a business is not present in Europe but is collecting European personal data and is providing services in Europe, they need to comply with the GDPR. So the same will have to be done for the Indian law. The Indian law is a little more facilitative than the GDPR, in fact, not quite as prescriptive. So a lot of the GDPR compliance requirements could port over, but there are certain important aspects to be kept in mind. Some of them may, in fact, even need engineering tweaks, such as the children's personal data processing will require verifiable parental consent. So the mode of getting that parental consent and verifying the age of the parent and identity of the parent, that's something that global platforms will have to make some tweaks over. So definitely the data protection law will have to be on the map for any international merger.
And this, you said in coming months, and I'm sure, is there no clear timeline as of now, or is there a clear timeline which is?
Unfortunately, no. It's at the discretion of the government as of now.
Okay.
So rules were published for public comments,
Yes.
and the window for public comments closed earlier this month. So one expects that those comments will be considered, and then the act will be notified, and the rules then brought into force.
Sure, sure. I think this is very helpful. I'm just seeing if there are any questions from our audience as well pertaining to some of the topics that we've discussed today. Yeah, one I think again I think it's probably a far more nuanced answer which can be given, but it's more catering towards how should a foreign company look to protect its intellectual property rights, the IPR rights when they're looking to enter India, especially in the tech and consumer goods segment. I think that's something which is a common concern.
Sure, sure. So the IP strategy can vary depending on uh, what is the priority towards the Indian market, and uh, what is the exact activity being carried out in India. Often, what we see is that for a global business, the headquarters is outside India, and the IP is owned at the headquarters or in another jurisdiction abroad. That IP is then licensed to any Indian entity which may offer the platform in India, if there is such separate Indian platform. And then such entities may also have a development center in India where Indian employees work to actually develop code for the global platform. In which case, that IP gets assigned by the Indian entity to the global entity on a continuous basis. So it's essentially a structure where the IP is owned abroad in most cases, and often developed in India and assigned to the global entity. And in some cases where there's an Indian platform, it would be licensed back to the Indian entity operating that platform. Of course, as far as registered IP is concerned, if there are any trademarks, brand names, it's important to try and protect those by applying for registration, assuming that uh, the the name and the mark qualifies for protection. That will help enforce the IP rights against third parties who may use similar names and brands.
Sure. Thank you, Jaideep and Mr. Nakappa. I really appreciate the fact that I have pushed you guys to answer extremely complex and nuanced questions in 2 minutes or 5 minutes, which is usually takes up books and chapters completely. So really appreciate the just to summarize for our audience. In terms, we think it is a very exciting time to enter India. I think there is a great opportunity to be had in India. There are obvious complexities involved in scaling in any country, and India is no exception. Traditionally, it has been pretty difficult, whether it's regulatory, compliance, taxation, payments, to enter India. This is something which has evolved a lot in the last 5 to 10 years, especially with the advent of PACB license. There are providers such as Cashfree. There are obviously consulting firms, law firms available as Trilegal who can help navigate this entire journey. Given the sheer size of the Indian market, we believe this is an extremely lucrative opportunity. As a last thought on this discussion, Kashfi also is launching our Winning in India ebook, which sort of summarizes some of the key elements of the discussion that we have had today, and it also sort of gives sort of access points on whom to reach for navigating whatever queries an international company might have. As part of our emailers, we will be sharing that ebook with the audience here. Uh, Thank you so much, Mr. Zeddy. Like, when any last thoughts that you would like to do? Otherwise, really appreciate your time across this.
Nothing from me, Harsh. Thank you. It was a pleasure speaking and attending.
Thank you so much, Mr. Kapil, as well. Thank you, Jaideep. I think that's it from Kashfi. Thank you, everyone, for joining in. Wish you a very good day or good night, depending on your geography. Thank you, everyone.
Thanks, everyone.
Thank you. Bye.